In M&A deals, cyber tail coverage has the potential to stall a deal, and often does, because everyone realizes at the 11th hour that this claims-made policy shuts itself off at closing. Suddenly the buyer wants a 3-year tail, higher limits than what you carry, and your broker is scrambling. Hey, if you're a business owner getting ready to sell, this is the moment to get ahead of so your closing doesn't slip. Hi, I'm Coyle, and for over 40 years I've been helping business owners navigate the complex world of commercial insurance. I've seen every problem and costly mistake you can imagine, and here I share the insider strategies and real-world solutions that protect your business and save you money. So let's dig in. Let's talk about what a cyber tail actually is. Most cyber policies are claims-made policy forms. That means the policy that's in force when a claim is reported is the policy that will respond. The second your policy ends, like at the closing of your company's sale, your reporting window ends too. But cyber incidents can sit undetected for months. A tail, which is formally known as an extended reporting period, or ERP, keeps that reporting window open after the policy terminates, so claims from your time as owner can still be reported and covered. The question is, what term does the buyer require, what limits, and how do we bind it on your timeline without all the drama? Here's the bottom line. In M&A, cyber tail shows up because buyers don't want legacy incidences becoming their problem on day 200, for example. Sophisticated buyers will often require a 12, 24, 36, or even longer tail, and sometimes at limits that are higher than your current policy. If your team hasn't handled this before, you get 3 predictable traps that stall the closing. The good news, each of these traps has a clean fix. Trap 1 is the panic response. We need a tail now. Everyone agrees to the tail in principle, but no one knows the carrier's actual ERP menu, the pricing, or the approval path. Emails are going to fly, the clock is ticking, and underwriting wants details that aren't at hand. Here's how we fix it. We pre-negotiate the ERP options early in diligence. We confirm available terms, 1, 2, 3, or 6 years, the cost basis, any conditions, and the exact endorsement wording that the buyer's attorney wants to see. We draft binder language in advance, so when you say go, the carrier issues the tail endorsement and a certificate with the right terms and right limits. No last-minute surprises, no chasing signatures at 7 o'clock on the eve of the closing. Trap number 2 is the limits mismatch. The buyer requires more limit in the tail than you currently have. You carry $1 million limit, the buyer wants $3 million for 36 months. Most brokers freeze here because they assume that you can't change the history. In reality, there are 2 viable paths. The first is a retroactive limits increase on your current policy before it terminates, and then you attach the tail to those higher limits. That's often the cleanest solution if the carrier will do it and the risk profile supports it. The second is to structure an excess or standalone solution that matches your retro date and responds during the tail window. It takes careful wording so claims reported in the ERP flow properly through the tower. Our job is to translate the buyer's ask into a carrier feasible plan, push where it's reasonable, and document exactly how the limits apply during the tail. Trap 3 is the big one and the one we see very often. There's no cyber policy currently in force, but the buyer still demands a tail. You can't buy a tail on a policy that doesn't exist. The fix is to bind a primary cyber policy with an appropriate retro date that reaches back to a reasonable point in time, often to when meaningful data exposure began, and then immediately attach an ERP endorsement at or just before the closing. That requires carriers who move fast, understand M&A timelines, and will entertain a retro date which makes sense. We know which markets do this and which don't, and we package the underwriting story to get it done without dragging out the deal. Let me give you a quick example. A manufacturing client who was selling to a strategic buyer required a $3 million cyber tail for 3 years. The seller had $1 million in force. We approached the incumbent carrier first and negotiated a retroactive limit lift to $3 million with a modest premium adjustment based on the controls and the loss history. With that increase, we finalized the ERP endorsement for 36 months and aligned the certificate language to the purchase agreement. Everything was executed 2 days before the closing and the deal stayed on schedule. That's how it should work. There are nuances you should know. Cost matters. A 3-year tail typically runs in the ballpark of 150 to 300% of the annual premium, and who pays it is a negotiation point in the purchase agreement. Wording matters too. Confirm the retro date, the definition of claims, the consent to settle procedure, and whether you must use panel vendors for forensics or legal if a legacy incident surfaces during the tail. Sanctions language matters as well. If a claim involves a sanctioned actor, your policy still needs to respond to the rest of the event, even if a ransom payment isn't permitted. Finally, timing is everything. You don't want to purchase tail months before the closing if the deal might not happen. You want terms quoted, wording approved, and endorsements queued up so you can bind it when the docs go final. What does this mean for you? If you're within 60 to 90 days of a potential sale, let's pressure test 3 things right now. First, confirm the tail menu and pricing with your carrier so you know exactly what's available. Second, if you suspect the buyer will ask for higher limits, evaluate whether a retro lift is feasible, or if we have to, plan on an excess solution. Third, if you don't have cyber today, decide how far back your retro date should go and which carrier will move quickly with clean wording. That preparation turns a known friction point into a non-issue. Here's how the Coyle Group approaches it. We start with your deal specifics and your risk profile and not boilerplate language. We talk to the buyer's team, align on what they truly need versus what's nice to have, and we translate that into carrier terms that can actually be bound on your schedule. We own the checklist, the underwriting, the packaging, the terms, limit strategies, endorsement language, certificates, and timing. We keep both sides informed so everyone knows the tail will be in place at closing. If you want more background on cyber mechanics beyond just the tail, we've got a full cyber insurance hub page that unpacks related insurance coverages in plain English. The question is not, can we get the tail? The question is, can we get the right tail with the right limits and the right wording on the right timeline so the deal closes? That's the game. When you handle the tail proactively, you reduce the friction. You lower the chances of a post-close dispute, and you signal to the buyer that you've run a clean, professional process. If you're facing any of these traps, or you just want to make sure that they don't show up, reach out and let's talk through your options. We'll map what the buyer wants and what the market will do. We'll price it and line up the endorsements so you can close without a surprise.